Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all my own original work, as I think you deserve to have that. So with that, Chicago soybeans. Before I get down to this week's actions, I think I should once again set the scene here. 23 weeks ago, I highlighted a bright pink July 24 to date rectangle pattern, currently 959 to 1100. This pattern is still operational, even now. We are now roughly midway between the pink upper trend line and the pink lower trend line. Near the pink lower trend line, we also have the unreconstructed bright green 2019 to date uptrend, currently at 970 and a quarter. And these two helped explain the hesitation seen over late July and early August before the market turned back up again. Now, there have been some other patterns here, such as the mid-July break below the late April to mid-July expanding wedge pattern, as well as an earlier mentioned double top. However, I have not highlighted these anymore, nor kept their secondary targets, as they are no longer viable nor valid. I should note the primary targets were reached on these, just for good order's sake. The patterns that we have seen that still resonate today are firstly a quite steep bear channel, developing from late June to last week, highlighted in dark blue on my daily chart. The bearish pressure of this pattern was disrupted, with prices shooting up and out of the bear channel, reaching up as far and seemingly hesitating at a former important level, which is the broken upper time, currently 1032 and 3/4, of the December 24 to April 25 bullish shift pitch hook, along with the mauve medium moving average, currently 1032. But that doesn't really look like it's happening today. It looks like we're shooting higher even still. Just above it, we have the November 2020 low at 1045, which capped the market start this week. And to be honest, the next real one is a lesser Fibonacci line round about the 1060 area, and possibly even as high as the 1082 and a quarter high we saw back in June. Looking below, we have the combination of the green short medium moving average now, which is currently at 1021, the 50% Fibonacci line, the June to August 25 move at 1022, and importantly the flatlining gold long moving average, currently 1026. I said as much last week and call this, and I quote, basically the next overhead congestion in depth area between 1016 and 3/4 to 1031 and a half, end of quote. I actually would finesse that this week to have been in between 1016 and 3/4 to 1032 and 3/4. That's the area of support we have below the market. Now, this move up opened the possibility for a possible topping action, which doesn't look like it's happening today, but it may be that we will go sideways for a while to possibly now looking a little bit higher still. Interestingly, the changeover gap left at the start of July between 1047 and 10¾ has seen an attempt to fill it, and today it looks like it's just about being filled. And I would monitor that gap to see how far we achieve any further filling in on any further tries higher. So, outside the big rectangle pattern I spoke about at the start of this commentary, I have little in the form of major new patterns to discuss right now. Just keep an eye on those moving averages below, the gaps, and a wary eye on that broken lower time, and then potentially at the highs we saw in June and in May. Chicago soybean meal. 19 weeks ago, I linked some of the early 2025 highs into a bright red downtrend, and then the lows at the time into another purple trend line below. And together they made a January to August descending wedge pattern. This pattern was broken on the downside in late July, and in the process of breaking lower, the market initially made what looked like a hesitation before clarifying the action over July into a dark blue descending expanding wedge pattern. However, that morphed even further into a July to August reverse head and shoulders pattern, and last week prices broke up through the dark blue neckline, currently at 282.40. This is not the only thing the market broke higher through, as it also broke higher over the bright red upper trend line, the purple lower trend line, the green short medium moving average, currently at 280.20, and tested the overhead mauve medium moving average, currently 288.30. This week the market has moved higher still, through the mauve medium moving average, plus significant congestion at 290.80, and now looking to challenge the combination of the 50% Fibonacci line of the whole of 2025 move at 294.5, and a flatlining gold long moving average, currently at 295.10, both above the market at the moment. All this now has to be taken with a pinch of salt, as we had back in late June what looked like a decent break lower, only to find it was a false break. We now have to look carefully to see if this will also become a false break, just on the upside instead of the downside. It also causes me now to retire some targets, the secondary harder to reach targets below for the break under the descending wedge pattern. Interestingly, we reached the primary targets for this pattern down in the 273.20 zone already. Now this leaves us with potential topside targets for the newly reconstructed or newly constructed reverse head and shoulders pattern, which I gave last week of a primary target X up in the 296 area, with a secondary harder to reach target X2 up in the 301.60 area. I continue to wonder if these targets will be fulfilled, despite how close we are to the primary target due to the congestion overhead. Some of it will be already within, dating from April to August 2020, between 282 even to 300 even, but also some of which we have constructed in 2025, probably from the same source, which is between 294.5 to 302.25. For all that being said, it seems appropriate to lay out some potential targets topside for this break higher out of the descending wedge pattern. Thus, primary target X1 would be in the 309.70 area, with a secondary much harder to reach target X3 up in the 326.60 area. Part of me is a little loath to place these topside, as the break higher came very late and the chances of yet another false break are this time higher, and also much higher, but for now these will do. Finally, this commentary will not be complete without my discussing the elephant in the room, or at least the elephant in the room which has stayed there throughout 2024 and also resonates now into 2025, and that is the annual key reversal seen here at the end of 2023. I said I'm afraid I have to repeat something I've highlighted for 115 weeks. Yes, well over 2 years now. And I quote, "I now only need to remind you once again of my words when I pointed out the Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023 and I've been living in the shadow of this pattern ever since." End of quote. I've also added here ever since, and I quote, "If there's only one thing you take away from any of my musings, let it be in those words." And that's the end of that quote. These last few words have shown once again that the shadow cast by that supremely significant pattern so long ago still darkens the skyline of this market today. Chicago soybean oil. The key pattern here has been the dark blue ascending expanding wedge pattern, currently 51.96 to 61 even, and or it could be the larger bright green below, trend line below, and dark blue trend line above ascending wedge pattern. So it's actually one wedge pattern, but it could actually be a larger one if you take into account, ignore the lower dark blue trend line and take into account the lower green, bright green trend line. And that larger one would be 48.38 to 61 even. To explain this strange conundrum, I refer to my commentary from 10 weeks ago when I said, and I quote, "A new pattern emerged over the last month or so, one that I warned may kick off 2 weeks ago," so that's now 12 weeks ago, "and has actually done so since, though the break has not fully stabilized as yet. It is the dark blue start of April to end of May ascending wedge pattern." End of quote. This pattern has the appropriate number of touches on each side. Now, back late 12 weeks ago, we had a brilliant breach and break lower, but as I said 11 weeks ago, and I quote, "Clear consecutive closes below the dark blue lower trend line, I would feel obliged to lay out potentials and even possible targets below for this pattern, something I am not confident in doing just yet as I fear a possible false break lower." End of quote. Since then, this pattern has repaired itself, and the market went back well within it, climbing higher during most of July after June's monthly key reversal up, but turning lower once more in late July with a weekly key reversal down 2 weeks ago, when prices tried to enter the overhead congestion stretching between 56.34 to 59.44, and found out that this congestion only too easily eroded the bullish incentive. Now, there's one other feature I'd like to draw your attention to, and it's to look at the possibility that the lows of April and June can come together to form a new lower trend line, which I mentioned earlier, highlighted in bright green on my daily chart. This would be a new lower trend line to the original ascending expanding wedge pattern. I've still not fully explored this idea as yet, but I do feel obliged to lodge it in both your mind and in my mind, just in case. So last week prices dropped down through the important 50% Fibonacci line of the March 20 to April 22 move at 53.59 and utilized this as a capping action. This 50% Fibonacci line is being tested right now. It's actually quite interesting. It's the gateway to overhead congestion that stretches from 56.34 to at least the top of my daily chart at 59.44. All this action had earlier caused a monthly key reversal up here for June. However, last week saw the market move down through the rising green short medium moving average, currently at 53.30, though it's moving above it today, and down to test the dark blue lower trend line. This week we've seen prices move down through that dark blue lower trend line, as well as the March 23 high, and down to test the rising medium moving average, the mauve medium moving average, currently at 51.14, filling in the changeover gap left over from June. Actually, it would be ideal if this just filled in the changeover gap and went straight back up again. And that's left over from down at 50.81. And this is where a previous conundrum I had about this market's actions and pattern comes into play. You see, I do regard the dark blue trend lines as a definitive ascending wedge pattern, or do I look at the bright green trend line below as the real and true lower trend line for the ascending wedge pattern? Today may sort of help in that response, but I don't have an answer to this as yet, and I'm wondering how long I'll be able to now. The one thing I can add is something I said last week, and I quote, the singular mauve rising medium moving average currently at 51.14, as well as the old March 2013 high at 51.26. And to be the devil's advocate on this, if these go, then the green uptrend and the potential mentioned earlier of an even larger pattern may be on the cards, end of quote. So the potential is for a larger pattern, but doesn't look like it's happening, and we could be actually on for a weekly key reversal up. Thus, it seems as if the mauve moving average breaks, not breaches, but breaks, has to be a break, then the larger pattern may be on the cards. But at the moment, it looks like the larger pattern is not on the cards.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.